Good morning, everybody. Since it was established 4 years ago, Infrastructure Australia has been keen to encourage more investment in infrastructure by superannuation funds. Encouragement is my objective this morning, and in the 10 minutes or so that I'll be speaking, I plan to say three main things, all of which have been foreshadowed by partly what Geraldine said, by the interviews with people randomly chosen, no doubt, from the streets of Melbourne, and from the young person who introduced those clips. We all know that Australian superannuation funds have extensive investments in infrastructure. Between 5 and 10% of assets, this is amongst the world's highest level of pension fund investments in this asset class. But we've seen some very substantial changes in the way this country's balance sheet is structured over the last 40 years. Not so long ago, Australia's publicly owned infrastructure included all or nearly all railways, roads, seaports, airports, electricity and communication networks, apart from radio and TV, dams, water supply systems, and most metropolitan transport. That's to say metropolitan public transport. In the last 40 years, we've privatised some assets in most of these categories, and there's been extensive investment in those assets by superannuation funds. The Infrastructure Finance Working Group issues paper that was published last July estimated that superannuation funds provide something like 70% of equity investment in Australian infrastructure. This equity, of course, is held mostly or exclusively in privately owned assets, including build-own-operate and build-own-operate transfer concessions. The first point I want to make is that notwithstanding all of this, superannuation funds don't provide as much infrastructure financing as they could in a slightly different world, as they may be expected to, or as much as pension funds used to do, or pension liabilities used to finance not very long ago. Again, as we know, superannuation fund assets in Australia stand at about $1.4 trillion. About a third of that's held in CMSFs, whose investment in infrastructure is pretty much restricted to the small number of listed infrastructure companies and funds. Looking only at APRA-regulated funds, if 10% of their assets are held in infrastructure, that's about $100 billion, but that's only about $5,000 for each Australian. And that's a small proportion of total infrastructure, however our first presenter this morning would have defined it. So the question, how come superannuation funds have so much of the available equity but still a small proportion of total infrastructure, has an obvious answer. And the answer is that most infrastructure is publicly held and not available for investment. Changing that is a significant national priority in which superannuation funds have an important part to play. My second point, as you might have guessed, is that the problem of finding finance for infrastructure is largely with the public sector, because governments and GTEs don't put their businesses in shape to sell or in shape to raise finance. Nor have governments, individually or collectively, assembled a pipeline, although this is to some extent being addressed through the National Infrastructure Construction Schedule that the Commonwealth Department is working on and is due to announce in the next couple of months. As has already been said in this session, our infrastructure in Australia is ageing. The national requirement for new infrastructure is conservatively estimated at $500 billion over the next 10 years. With the current fiscal imbalance between Commonwealth and states, with the Commonwealth budget straining to reach a surplus, and with states borrowed within a notch of their credit ratings, private sources are going to have to provide a lot of this finance. So does this picture amount to a set of wrongs, as the title to this session suggests? And if the answer is yes, how can the wrongs be righted? I wouldn't say wrongs, but it is clear that financing new infrastructure is a national problem that governments can only solve by raising private sector investment that isn't debt. Why not debt? Well, that's obviously a consequence of the AAA paradox. Governments don't want to risk their ratings as safe borrowers by actually borrowing, at least not to finance assets that can be funded in whole or large part by user charges. An alternative to debt is for governments to finance new infrastructure through asset sales. The sale of the Port of Brisbane here is a recent example in which superannuation funds were a significant part of the buying consortium and in which the funds were both themselves targeted for new infrastructure, and also it was part of the deal that additional road infrastructure would be constructed by the winning consortium. In New South Wales, the government is trying to emulate Brisbane's example in Port Botany, and again the proceeds are earmarked for much needed infrastructure. But there's a limit, obviously, to the extent to which governments can fund new infrastructure through asset sales. The limit's partly a political aversion to selling off the farm, but governments do need to look at flexible responses to financing and funding their infrastructure needs. PPPs are one of those approaches. Arranging private sector provision of new infrastructure through a PPP avoids sale and involves private sector financing. In what I'm talking about this morning, I mean by investment a form of equity but not shares in a company. I mean non-debt contracts whose effect, as with PPPs, is at least partial transfer of business risk and partial transfer of control in a situation where returns are dependent on business results. PPPs are familiar territory for superannuation funds. However, the focus on construction and construction finance in putting together PPPs has meant that the role of superannuation funds as long-term holders is often not emphasised. There are changes to the tax treatment of carry-forward losses proposed. They were announced in last year's budget, and they will have the effect of making it easier to separate PPPs into two stages, the construction and construction finance stage and the long-term financing stage. But these changes won't initially affect all PPPs. They'll apply only to a selected $25 billion of infrastructure projects, and that's a small fraction of the total infrastructure pipeline. And no doubt the experience with that first tranche will affect whether or not the concession's extended. Now, while PPPs aren't financing mechanisms, and they shouldn't be seen as financing mechanisms, they do involve the provision of private finance and therefore reduce the call on a government's budget. Of course, that's not a sufficient reason to use a PPP, but a consequence of a decision that should be based on risk allocation grounds. But even with both asset recycling and PPPs, it's by no means certain that governments will be able to fund a massive infrastructure program. Another source is to unlock some of the value in existing public holdings without selling the underlying assets. Infrastructure Australia is undertaking an analysis of Australian GTEs, government trading enterprises, and their businesses. The analysis is to identify what needs to be done to put GTEs or businesses in shape to be sold, or in some cases to attract investment. Independently regulated pricing mechanisms is one obvious requirement, still often not in place, and that's certainly a requirement for monopoly asset sales. As the infrastructure task builds, as it's currently building and perceived to be an important national task, decisions will have to be made by governments whether to recycle capital by selling existing assets or to seek private sector investment on terms where there is some transfer of risk and some transfer of control. The operational phase structures with which we're reasonably familiar in PPPs are an example of providing finance based on the value in GTE businesses. The sort of investment which superannuation funds can be expected to make and would expect themselves to make in infrastructure is likely to be unleveraged or low leveraged to avoid the transfer of value to short-term investors that occurred in many refinancings before the GFC. For example, a water supply authority could structure some of its network supplying specific users as a separate business and raise long-term private sector investment for that business involving real risk transfer. Any agency that operates a physical network can take a similar approach. The financing objective in this sort of structure is to separate the component business enough to generate a stable external cash flow which will support an independent investment structure. Obviously, financial structuring in this sort of deal is involved. I won't go into that in any detail this morning. It's familiar territory, in particular to funds managers such as Hastings and IFC. But what I want to do this morning is to emphasise that that's a possibility. So to summarise, the ways in which governments will find the additional private sector investment for new infrastructure is yet to evolve, but seeking investment in existing operating assets is both a reasonable possibility and a potential opportunity for superannuation funds. My third point of three is that superannuation funds have an opportunity to pitch hard and smart on infrastructure. The expectation, the political expectation, the community expectation is building that superannuation funds will provide much of the infrastructure, much of the financing to address the infrastructure backlog, and that needs about $50 billion a year. Super funds can engage that expectation by providing some possible answers. And that's the smart part of what superannuation funds can do, to stay involved in the debate about infrastructure financing, to push for the restructure of PPPs to allow construction and operations phases to be separated, and so that the role of superannuation funds as long-term finance providers is more often the tail that wags the dog. Another is proposing terms for the sale of existing assets where appropriate, and in other cases proposing ways in which assets can provide private sector investment without being sold. There is a lot to be said, as you all know, a lot to be said politically for a stable long-term funder with the political appeal that superannuation funds have. And presumably, in terms of asset allocation and reward, super funds would prefer the higher returns on such investments provided the transfer of risk is adequately rewarded or the terms of control and financial return are adequate. Superannuation funds are the financial sector's natural long-term equity investors in both publicly held and privately held infrastructure. This is not a role for retail banks. It's an important differentiation between the role of superannuation funds and the role of banks. Banks will provide debt. Still less is the long-term role one that's appropriate for private equity providers whose interest generally is in short-term returns, nor is it any longer a role for the structures that investment banks used to use before the GFC. Again, we all know that there are regulatory impediments to superannuation funds increasing their commitments to long-term investments, including requirements to maintain liquidity, although allocation to illiquid assets will become easier as we move more to whole-of-life super. But super funds would do well continually to emphasise the link between removing these impediments and their capacity to make desirable infrastructure investments. More investment in infrastructure means more complex risk and return assessments. Fund managements and aggregators like IFM and Hastings will continue to play a key role providing the necessary skills and through aggregation the opportunity for smaller funds to participate in large investments. But with all respect to those organisations, the political message should be delivered by funds themselves. Superannuation funds individually and collectively have the brand and the standing in the community to deliver the message that they're ready to invest in infrastructure and the standing to press governments for deal flow for necessary regulatory amendments and for the opportunity to invest in existing infrastructure on reasonable terms. Of course, the attachment to infrastructure will have to be genuine, with funds prepared to promote the benefits of this type of long-term investment and apparently lower but more stable real-term returns. So the objective of Infrastructure Australia can be put this way. What it wants to do is to encourage increased involvement of Australian superannuation fund members and the superannuation savings of Australian workers in the ownership of Australian infrastructure. If you will, to encourage funds actively to right the wrongs. Thank you.
Thank you very much, Michael. I think we know where you stand. Gary Weaven, I think, will be well known to many of you. He's Chair of Industry Funds Management, IFM, and of course has been very involved in the championing of Pacific Hydro, a leading renewable energy company in Australia and Latin America. He's also Director of Members Equity Bank and was a foundation board member of Melbourne's Docklands Authority and its successor Vic Urban. His involvement with superannuation funds management industry, of course, followed his involvement in the union movement when he was Assistant Secretary of the ACTU in 1986, and he, as you well know, has played a seminal role in the development of the industry super fund movement. So I welcome his thoughts on where this heads next. Gary.
Thanks. Thanks very much, Geraldine. Well, I'm very pleased that someone from a government agency didn't repeat the infuriating thing that comes so often out of the mouths of both federal and state politicians, that wouldn't it be, why don't you invest more in infrastructure, as you superannuation boffins, why don't you invest more in infrastructure? Because the fact of the matter is that while that does get bandied around in political circles, the reality is that the big stumbling block is actual deal flow in Australia. Well, around the world to some degree as well, but certainly in Australia where we've been making the noise for a long time, but the deal flow has been spasmodic at best. As you all appreciate, most deals in the infrastructure space do require substantial government involvement. It either involves a government asset sale or at the very minimum substantial government facilitation, usually state government facilitation, because that's where most of the infrastructure assets are owned. And continually we seem to find one political reason or another getting in the way of that deal flow, and perhaps we can come back to that in discussion time. IFM, as a consequence, has been a very major participant in international infrastructure deals, worth probably around about $4 billion, those deals over the last 2 years. While in Australia, our last new deal was a chunk of the Port of Brisbane. When I say last deal, excluding investments by the actual portfolio companies themselves, because obviously a number of the assets we own are investing themselves. But excluding that was the Port of Brisbane. That was a total around about a $2 billion deal in terms of total enterprise value, but our role at around 26% of the equity. It was, of course, a much smaller cheque than that. So there've really been not that many other opportunities of scale in Australia. The Vic Diesel plant is in recent memory and still in the headlines. We very wisely, as it turned out, did not participate in the equity, or as it appears anyway, did not participate in the equity, but we did on the debt side. But super funds are involved in both the equity and debt side. There was no difficulty of any great moment in raising the funds. The project got underway. So when the projects have been available or the assets have come up for sale, the funds have been ready. In fact, just to prove that point, I'll leave this. This is the only slide I'm going to use, I think, because I noticed Mike Fitzpatrick will cover a number of the other material. But just to show the sorts of things that we're actually talking about, to give you an idea, that's the Australian and international infrastructure current portfolios of IFM. So, notwithstanding the contracting share market, which has an impact because obviously a lot of funds either are or believe they are underweight in listed equities at the moment, and are looking to rebuild their listed equity portfolios when they get the chance or think the time is right. And that does put some limit on the ability to raise new money for infrastructure. But notwithstanding that, I think I can safely say that at the moment, shortage of funding is not the problem. Shortage of deal flow is the problem. And why wouldn't it be? I mean, one, if I may be permitted something a little like an ad, that Australian fund, 16 years now since inception, has delivered over 12% per annum, after tax, after fees, for 16 years. So you can imagine there's not actually a reluctance of people to be willing to explore the idea of investing in infrastructure. The problem is supply of deals. Even where the state government facilitation is not strictly required, for example, in terms of renewable energy development, where we have the 2020, the 20% by not 2020 policy in place, bipartisan policy on the face of it. But even in that case, really politics, together with the oligopolistic retail electricity regime, has conspired to slow down development. There needs to be $25 billion worth of investment in that industry by 2020 to achieve that goal. There is absolutely no hope of that being realised at the current pace. Retailers who have the ultimate obligation to deliver renewable energy to their clients under that scheme are very slow, really, to contract their future renewable energy obligations because they're pretty much hooked, really, on coal-fired assets and gas projects of one sort and another. And they see, I think they also see bipartisan support for renewable energy as somewhat fragile. So that's a shame, but then the world is a big place. And, but it is a shame for Australia. So I think, to repeat, there is, no, at least in terms of industry funds and public sector funds, and obviously for the very small funds it's harder, but for public sector funds and industry funds there has been no shortage of support for infrastructure investment. However, having said that, it is certainly true that, as Michael has hinted, it is certainly true that if some of those political blockages were removed and the states did actually step up to the plate to facilitate current and future infrastructure needs in terms of roads and rail and ports and energy, water and health infrastructure, and all the things we need to do to make that infrastructure modern and sustainable and drive productivity, if they did step up to the plate, then we would very quickly run into a shortage of funding because that amounts to hundreds of billions of dollars potentially over the next decade. And there is some liquidity constraint on funds. Some of it is imagined as a result of people getting frightened in the GFC and the member switching and all of that went on. So some of it's imaginary, but there is also some real liquidity constraints. You can't simply expect, under our current regime, which encourages really switching, you can't expect people to have 80%, 90% of their portfolio in long-term assets, particularly unlisted assets. So part of the answer, no doubt, will lie in attracting offshore funding. You will have noticed, those of you who follow the financial press, and I hope that's most of you, you will have noticed that Canadian pension funds have already been quite active in this market. Some years ago they pinched one of our earlier heads of infrastructure and they've built pretty substantial positions and they are active in this market. The IFM itself has now got 24 offshore clients, most of them, all of them in the infrastructure space. Most of them are US-based pension funds. So there is quite a potential appetite from offshore that can be brought to bear on the Australian infrastructure shortage, if indeed governments translate shortage into an actual doing something about it. That number is likely to grow very strongly from all the signs we're getting and the very strong interest from offshore. But that is somewhat second best. If you really want to connect the Australian superannuation industry, if you want to say we've got a world-leading Australian superannuation industry, let's connect it in a unique and genuine and binding way to our need for enhancement, long-term enhancement of social, environmental and economic infrastructure. And if you want to do that by leadership rather than by mandatory measures, then I offer you the following game-changing model, which I'll just quickly run through. This model, I think, could apply to both existing assets and to new projects, or could extend to a combination of assets and projects packaged up in one deal. The first step would, of course, be that the government, state or federal, or both as the case may be, would have to carry out the necessary due diligence and appoint one or more fund manager or consortium to work with it on a particular asset sale or lease or new project. Or the government could alternatively, I suppose, pre-qualify a number, although there wouldn't be many who could be pre-qualified in Australia now, as Michael probably comment on. But they could pre-qualify a number of such managers as approved infrastructure super partners and rotate deals. The second thing, and the crucial thing, is that the manager to participate, would have to agree to a cap on fees, a fixed asset fee, a percentage asset fee over the life of the ownership or the project, and would have to agree to no other benefit, direct or indirect. They would have to specifically rule out related party transaction fees, refinancing fees or other sources of income from the deal. That would be ruled out. The third thing is the parties then seek to negotiate on an open book basis, can be completely transparent to the public, open book basis, an internal rate of return, base case internal rate of return, which of course will then fix the base price. The parties would probably, if they have any ability, they would probably also try and negotiate a range, a low case and a high case internal rate of return and price, a price below which and a rate of return below which the taxpayers, the government, would put a floor, and a rate of return above which the taxpayers or stroke government would participate in that upside. Having done that, and let me say clearly, the government, thinking flexibly and creatively, can use a whole range of measures to shape that deal and shape that risk-return profile. It can use directly its regulatory powers, it can use its deal structuring powers, obviously, and sometimes it can use its role as a customer to strongly influence the risk-return matrix at that point. The manager also, or the consortium, can use its technical and creative capabilities at that stage to influence the shape and even the size of the deal. If agreement is reached on that negotiated basis, and it doesn't have to be reached, but if agreement is reached on a transaction price and terms, the manager must, and this is the key clause, the manager must then offer the deal by way of a pooled superannuation trust or similar to any APRA-approved superannuation fund. The manager would be responsible for marketing it to those funds, to all the funds who wish to participate. If the deal is oversubscribed, that is, if the demand for the deal at that rate of return and price is strong and the deal is oversubscribed, units could be issued pro rata to the super funds based on their dollar size or their number of members, or on some formula incorporating both asset and member size. If the deal is undersubscribed, then the first thing the manager could do would be to look for non-superannuation sources, or including offshore funding, to make up the difference, or otherwise it could put it back to the government, and the government would either then withdraw the deal or downsize the deal or by providing its own capital for some of the deal, or it would sweeten the deal up to make it more attractive, for re-offer then to all the super funds in Australia again on the same basis. The attractions of that model, I think, that firstly it can be completely transparent at all stages, that bid costs are largely reduced or removed. If outperformance, and this is crucial, if outperformance occurs, then it should be relatively non-controversial. The benefit is widely spread through the workforce and the citizens, and retirees rather. There can be no windfall profit under this model to financial intermediaries, including the manager. The manager holds and develops the asset long-term for a fixed fee. If the asset grows in value, the fee would grow. It can sell the management rights, but the set fee remains and all performance goes to the investors. So if there is a windfall gain, it goes to the investors on that widespread Australian workforce and retiree basis. And there's a full opportunity for the private sector to innovate in this process at the negotiation stage and over the life of the deal. And there is a clear preference to super funds and to Australian ownership in the deal, but not an exclusion of external capital. So I think such a model would completely transform the investment landscape for infrastructure, creating a world-leading partnership between governments and our world-leading super system. It would truly link, thanks Julian, truly link the needs of our retirement income system for strong, long-term, reliable returns with the nation's other long-term imperative to lift productivity and environmental account of sustainability. So the only impediment is political. The main message, however, for government, I think, is show us the deals. Even if our political system is incapable of implementing something as rational as the Weaven model, it surely would be capable, you would think, of recycling some infrastructure assets to allow super funds to hold these long-term while governments use the proceeds for new infrastructure. Thank you.
Good big dreaming from Gary Weaven. This is wonderful. Now, our final address today comes from Mike Fitzpatrick, who's chairman of Infrastructure Capital Group, a good sand groper like me, has 1975 Rhodes Scholar from WA. With over 28 years in the financial services sector, he's chairman of Infrastructure Capital Group, chairman of Treasury Group Limited, which is an incubator of fund management companies, and also chairman of the AFL, with a number of non-executive directorships under his belt as well. So a busy man, and I'm delighted he's here with us today. Thank you.
Thanks very much. Morning, ladies and gentlemen. I need a ruling on whether the previous speaker broke the rules about advertising. Do we have a ruling? I mean, if they haven't seen any deals this year, I can tell you Infrastructure Capital Group's seen 3 or 4, so it's not...
You can go for it too.
But to be fair, they're generally much smaller scale.
It's clock's ticking.
What I wanted to do... I've got 15, he only had 10, I think. What I wanted to do today was to, first of all, congratulate the superannuation fund movement. They've just made a great contribution, as was said, to infrastructure in Australia, and particularly to equity. And that's been true since the mid-90s, and most of you have 5 to 10% allocation to the space and have supported new infrastructure in Australia for the last 20 years, nearly 20 years. And you've been rewarded, as my next slide will show. And today I wanted to have a look at the evolution of infrastructure from the mid-90s through the crash of 08, 09, and then spend most of my time on the current market and outline my rather firm views on how you should invest. And controversially, and probably as you might expect, my view is that just to give you a heads up really as to where I'm going to finish, my view is you should look to allocate 5 to 10% of your balance sheet to unlisted, open-ended funds investing in Australian assets. And I do think, as has been said by the 2 previous speakers, the opportunity in Australia is huge, and to some extent the difficulty has been the inability to connect between government and the investment side. And to some extent that's led to many of the super funds actually looking at infrastructure assets offshore when many assets should actually be available to them in Australia. So we look at where we are in 2012, and we're in the middle of one of the great mining booms. We can look at our cities, we can look at how we measure up to New York, London, Tokyo, Beijing, and we can look at what we've got, and we can look at what we haven't got. And none of our cities really, I mean, you could argue Sydney, but really has a functional ring road in the way London or Paris does. None of our cities really has what you'd call a decent metro. There's no dual carriageway from Melbourne to Sydney, let alone from Brisbane all the way around to Adelaide. Our telecommunications is expensive. Our energy markets are quite fundamentally flawed. We don't have interstate fast trains. In fact, we hardly have slow ones. And oh, you've been on them lately. And social infrastructure needs renewal. So super funds need to become part of this upgrading of our infrastructure to world class. I think you've been a party to it. I do think the opportunity is huge, and there will be, if we can get government, and I guess to some extent the managers and the investment banks and the other players in the market, if we can get that connection, I think there is a tremendous opportunity for us. And just to show you how rewarded you've been, this slide, courtesy of Frontier, is the underlying evidence to support my view on open-ended funds. And the asset consultants and the advisors can complain about illiquidity and advocate international diversity till the cows come home, frankly. But in the end, this asset class, in open-ended unlisted funds, has performed. Now, why has it performed? Partly because local managers and investors know the local assets. They know the rules, and one way or another, they will over time endeavour to influence the environment, and occasionally they'll be successful. These are long-term assets matching your liabilities in your currencies. And for the performance, quite frankly, in an MER sense, they're cheap, usually under 1%. So don't let the asset consultants talk you out of owning valuable Australian assets. You know, you can have Chilean toll roads or Icelandic power stations, but you know, frankly, I think the Australian assets are where you're going to get your performance. Now, where all this started in the mid-90s, I guess the point I wanted to make is that Australian governments sought to maximise proceeds from the sale of their utilities. This led to trade sales and the need for informed unlisted investors, of which there were very few. And the superannuation movement, and Gary Weaven was one of the leaders in this, saw the opportunity to earn significant rewards, and this led to the creation of vehicles such as UTA from Hastings, the restructuring of DAF, which ultimately became IFM. AMP and Deutsche were very active in the market. And the listed market at that stage did not exist. And these funds are now diversified, large and open-ended. 10 years later, the listed model had become dominant, and it was global. Australian investment bankers and funds were contesting and winning most infrastructure asset auctions around the world. Dividends were high and they were funded by debt. And the formula was simple on the listed side, as one of my investment banking colleagues outlined. So we look around for a good consulting firm, we buy the consulting firm. Consultants are user-friendly. They're used to marketing, they're knowledgeable in their industry, and they've always wanted a balance sheet so they could buy the companies that they advise. We buy the assets they choose, we put them on balance sheets, we flog them to the public as a fund, and then we never sell. So it was a great business, and it set up a very good annuity, and groups such as Babcock raised of the order of 50 billion of debt in a 5-year period. But unfortunately, the superannuation funds got caught up in the enthusiasm and pressed by, to some extent, trustees who could see the growth assets, high dividends. The gatekeepers urgently wanted assets and began to favour access over intelligent investment. So the vertically integrated players, the investment bank with the fund managed by consultants who could offer worldwide investment banking services to participate in auctions, gained access to the super funds, won auction after auction, and those that exhibited some sort of price discipline really battled to raise money. It couldn't go on forever. In 2008, the music stopped. The global listed funds exploded, they were dismantled, and they were quickly overwhelmed by a mountain of debt. The death knell for the listed infrastructure funds was Chris Lynch announcing that Transurban would only pay dividends from cash earned. Super funds found themselves in a liquidity trap of sorts where mandate and listed fund valuations fell and the access at any price model was exposed. Unlisted funds generally had not indulged as aggressively and survived. But it has left scars on the industry. Infrastructure funds, because they've continued to perform, are now regarded as overweight due to the poor performance of equities, the denominator effect. And it's difficult to raise infrastructure money. And it's frustrating because at this stage, returns on infrastructure investment are arguably at their highest. The listed market is essentially now moribund. Those that remain are trading on such high dividends, no one could bring a fund to market. Super funds have struggled with the perception of infrastructure being overweight. And the other big influence now, the advent of MySuper, which is discouraging investment in any asset class which is not indexed with negligible fees. The fact that, as the graph pointed out, the sector has monumentally outperformed equity and bonds appears to be lost in the race to minimise MER. And this has led to a move to mandates, or SMIs, separately managed investments, and aversion to local open-ended funds. At the very large funds, in-house teams have been established. The market itself is more knowledgeable, particularly as regards regulated assets, and gradually super funds are picking up assets of which they are the long-term owners. Infrastructure Australia has become a force in getting the market organised and more strategic. And I welcome Michael Ayres being here today. I thought what he put together was very insightful and I think is the edge of explaining what they're trying to do. I think most recently, the working group has focused on getting super funds interested in infrastructure and trying to close that gap, revising the PPP guidelines, which needed work, but particularly recycling government assets and looking at land capture. And I think these are particularly constructive. If you look at something like the New South Wales desal transaction, which is running at the moment, where ideally that money would be rolled back into investment in other assets. So I think the idea of recycling, and I mean, interestingly enough, NBN is theoretically, doesn't appear on the government balance sheet because it is regarded as being an asset that will ultimately be sold. So the two criteria, I think, for it to be off the balance sheet were that the Senator Conroy had to basically say, one, that it would be sold, and secondly, you had to have a business case to say it would ultimately be a profitable business. We'll see how that goes. How to invest for super funds. And I think this is a big issue for you, and it depends on your size. But the larger super funds, such as AusSuper, are starting to build in-house teams in the way Ontario Teachers did 15 years ago. This is a big commitment. Last year, CPP, one of the Canadian pension funds, had a 26-person team managing 9 assets. And the experience there is the team needs to be large, multi-skilled, high quality, because the risks in infrastructure management are extensive. And having built that team, the most difficult issue is how to retain that group when the market becomes aware of them. In addition, in the event the fund acquires an asset, 100% or 51%, trustees need to be aware of the processes they have to go through to control their direct exposure to OH&S, ACCC, legal environmental risks, for which they may ultimately be personally liable. And I repeat, they may be personally liable. So this is one of the issues about about an in-house team and taking these assets in directly to a super fund. The smaller funds, 20 to 40 billion size, are rightly pursuing mandates, mostly in the form of SMIs. Although I'd certainly counsel them not to the exclusion of funds, because it's going to be very difficult to build the diversity. And if something unravels at an asset, be you a large fund with a big team, or say the $20 to $40 billion fund where you've got a mix of funds and say 4 or 5 mandates or 4 or 5 SMIs. If something unravels, say an individual is killed at, say, a compressor station at a gas pipeline, do trustees really want to be spending 50% of their time over the next 12 months sorting it out for an asset that's probably 1 to 2% of their book? So I do think in looking at SMIs, you need to do your homework as to how you're going to invest in them, how you're going to protect trustees, and in general, how are you going to build a diversified group of assets. And finally, smaller funds should consider open or closed-end funds, and having considered they should go for open. My personal view is the open will give you better returns at a lower cost, and the local funds, because you and your manager live in this environment, are more likely to give you higher returns. Now, I don't want to talk about the implemented consulting model. It's clearly a conflict of interest. It's been an absolute monumental disaster for several super funds, and it really shouldn't be considered by any trustee worth their salt. Am I clear enough on that one? I'm not going to name names, but really quite a terrible experience. To wrap up, I do wish to remind you that the opportunity is huge. And I think all that we've lacked in Australia is a vision for how to put superannuation funds and several, many of the government assets together. And I think we have to think through whether we want to be a productive economy with world-class cities, with ring roads, metros, intercity double-lane freeways, transport links, telecommunications and energy infrastructure that rivals the rest of the world, or do we just want to keep on the current piecemeal fumbling? Thank you very much.